Are you curious about cryptocurrencies, but not sure if you should invest? The fast growth and ups and downs of digital coins like Bitcoin and Ethereum raise many questions. Is it time to jump in, or should you be careful? We'll look at the good and bad sides of investing in cryptocurrency. Understanding cryptocurrency. Cryptocurrency is a type of digital asset that uses blockchain technology. This technology makes it decentralized, meaning it's not controlled by governments or central banks. It's secured by cryptography, which is a set of encryption algorithms and techniques. The blockchain technology supports more than just digital payments. By mid-2024, there were 10,032 digital coins available. The top 5 by market cap were Bitcoin, Ethereum, Tether, Binance Coin, and Solana. Transactions are fast, often confirmed in minutes. This is much quicker than traditional financial transactions, which can take days. They are cheaper, with lower fees for storing and sending money internationally. Types of cryptocurrency. The crypto world is full of different types, each with its own role. Knowing about different categories helps you see their value and risks. This is key for investors. Utility tokens, like XRP and Ethereum's Ether, help with blockchain work. They are needed for users to use services or apps on the blockchain. Transactional tokens, such as Bitcoin, are for making payments. They let users send and receive value safely and openly on the blockchain. Governance tokens give voting rights or other powers on a blockchain. They let token holders help decide the network's future. Platform tokens support apps built for a blockchain. They give the needed tools and resources for developers to create and launch projects. Lastly, security tokens represent ownership of assets, like stocks or real estate. They offer a way to invest in traditional financial products using blockchain. Understanding the purpose and use of cryptocurrency categories helps you make better investment choices. It's important for building a strong portfolio. How to buy them? Investing in digital coins is now easier than ever. More platforms and options are available. To start, visit a cryptocurrency exchange like Binance, Coinbase, Kraken, Bybit, KuCoin, Gemini, Bitstamp, OKX, Crypto.com, Bitfinex, just to name a few. These digital places let you buy, sell, and trade different cryptocurrencies at today's prices. After picking a trusted cryptocurrency exchange, set up a digital wallet. Wallets keep your digital money safe. You can choose software, hardware, or paper wallets for full control. Or use a third-party crypto investment platform or crypto ETF for easy market access without a personal wallet. It's key to do your homework, know the risks, and only invest what you can afford. With the right info and plan, cryptocurrency can boost your investment mix. Is cryptocurrency legal? The legal status of cryptocurrencies is complex and changing worldwide. In the United States, are seen as property or financial assets for tax purposes. But their rules are not fully set yet. The Financial Action Task Force, FATF, suggests that crypto transfers should follow anti-money laundering, AML rules. Even though cryptocurrencies aren't issued by any government or company, their legal status is unclear. Yet some places like El Salvador have made Bitcoin legal money. Around the world, regulation differs a lot. Some countries like China ban certain crypto activities. Others, like Japan and the European Union, have clear rules. Crypto taxation is also changing. The Union Budget of 2022 in India set a 30% tax on cryptocurrency profits. In countries like India, investors must keep records of their gains and losses for taxes. Should you invest in cryptocurrency? You need to weigh the reasons to invest in this market against the risks. Assets like Bitcoin and Ethereum can grow a lot in value, but they can also be very unpredictable and risky. Before you start, know your limits. Understand how much risk you can handle, your investment time frame, and your goals for diversifying your portfolio. Cryptocurrencies face many risks, like losing money due to mistakes, government actions, or technical issues. For example, Bitcoin's price has dropped by over 60% in the last year. At the same time, inflation rose by more than 7% in November 2022. In 2021, hackers stole over $3.2 billion. Also, only about 2,300 U.S. businesses accept cryptocurrency, out of over 35 million businesses. Investing in both cryptos and traditional assets like stocks can balance out risks. This way, you might get the benefits of the crypto market while protecting your investments. Cryptocurrency versus stocks. Investing in both has its own benefits and risks. For example, Bitcoin and Ethereum have seen big gains, but they are known for their volatility and speculative prices. Stocks, on the other hand, give you a piece of a company. They are valued by how well the company does. The S&P 500 has returned about 10% over time, making it a safer choice than cryptocurrencies. Regulation is another big difference. Stocks are watched by the Securities and Exchange Commission, SEC. But the cryptocurrency market is mostly decentralized and not as regulated. This means cryptocurrencies might offer more diversification, but they also come with more risk and less investor protection. Choosing between cryptocurrency and stocks depends on your risk tolerance, investment goals, and time horizon. Cryptocurrencies could lead to big gains but are riskier. Stocks are generally safer, but might not grow as much. A mix of both in your portfolio could be wise, but you need to think about your strategy and how to manage risks. Managing risks. Investing in cryptocurrencies comes with risks you need to know and manage. User risks include losing access to funds due to wrong passwords or addresses. Regulatory risks come from unclear laws in many places, which could cause sudden changes or disruptions. Counterparty risks happen when you rely on others to keep your cryptos safe. If they get stolen, you could lose everything. Programming risks are about bugs in smart contracts that control many platforms and lending services. To handle these risks, spreading your investments, using cold storage, and checking platforms and projects carefully helps. Knowing and managing these risks can lead to better investment choices and a safer experience. The future of cryptos. The future's looking bright, thanks to advancements in blockchain technology applications and changing government regulation. More institutional investment is also on the horizon. As digital currencies grow, they might become a big part of our financial lives and shopping habits. This could lead to more people using cryptocurrencies and the market growing. World governments are trying to figure out how to manage the crypto market. This could make the industry more stable and clear. With big players like hedge funds and banks getting involved, the sector is set to gain even more credibility and investment. The future is full of possibilities, even if it's not clear what it will be. The chance for new ideas and making money is drawing a lot of interest and money. As rules change and blockchain technology applications grow, we're in for exciting times ahead. Conclusion: investing in cryptocurrency can be complex and risky, yet it also offers big rewards. Before you put money into this new asset class, think about your goals, how much risk you can take, and when you plan to sell. It's key to weigh these factors carefully. And spreading your investments across different types of assets can help manage risks. This way, you can lessen the impact of sudden price drops. Also, looking at the long-term benefits and the technology behind cryptocurrencies might be smarter than focusing on short-term gains. Deciding to invest in cryptocurrency should be a thoughtful choice. You need to understand the market, its risks, and have a solid investment plan. By carefully considering these points, you can move through the cryptocurrency world with a clear plan and informed decisions.